Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Handford. This podcast is sponsored by CoStar as well as RealPage IMS. And with us today is Jalal Azar. And John, we're going to be diving into this property that your group acquired in February of this year, February 2020, called Petersburg Place, which is out of Augusta, Georgia. It's 82 units. And there's some unique things that have happened on this property just from reviewing the OM. So I'm looking forward to diving into this and kind of seeing what your plan was on this. But before we get started with that, why don't you give the listeners a little bit of background about yourself and where you are right now as far as the multifamily side of things are concerned?
Yeah, sure. Thanks for having me on. I have been in sort of the investment shoes for most of my career. Started out on the equity desk at Morgan Stanley, and kind of worked my way through different institutional investment platforms. From that point on, I launched my own structured finance company back in '04. With a couple of partners of mine, and we were doing essentially structured finance consulting for large developers on the East Coast and West Coast. We had projects in Boston, New York, Philadelphia, Miami, and we had a great run until about 2008, and then something happened in 2008 that stopped most of us in real estate. Little blip on the radar screen back then, and had to kind of restructure. Lost pretty much all our clients and had to start from scratch again, and had to go back and get day jobs and continue working for the man, I guess, if you want to say it, until we get to it's a different point. And this around the same time, my brother Tony had launched and founded Mac Venture Partners, or actually the previous incarnation of it, which was Mac Properties Group and Capstone Multifamily Group. And in '07, '08, we started buying multifamilies around the '08 timeframe, and then grew the business until I joined full time in 14, 15, and at that time I was living in Boston. I moved from Boston to North Carolina to join and help expand the business and get us to where we are today, which is, we're around 6,000, 6,300 units in size. And we manage a little bit more than that, just because we manage a few hundred units more because we retain management of properties that we sold in the past, that we stayed on as a manager. So that's where we are. That's the 30,000 foot view.
Awesome. Well, let's go ahead and dive into this acquisition that you guys acquired earlier this year. Again, it's called Petersburg Place, 82 units. Let's dive in and talk to you a little about how did you guys end up finding this particular deal?
So this was somewhat of a semi-marketed deal. I mean, I guess it was marketed, and what you'd call semi-marketed, but they sent it out to a few clients. The deal itself was, it kind of it intrigued us from the beginning, just because we owned and operated assets in Augusta, Georgia. We still own one of our oldest assets is actually in Augusta, Georgia. And the reason this was really appealing to us is first, we like townhome communities. This is a townhome community. This was initially built as a condo project, and it still is a condo project to some extent. So it was built to feel more like a home. Most townhome communities to us feel more homey, and they attract more family. We like the type of tenants that townhome communities attract, and so this was the initial appeal for it. The second appeal is that it is a part of a broken condo project, and there's a possibility to acquire an additional 20 some units to add on on top of that portfolio. So the initial sale was 82 units between a couple of different owners, and then there are 20 other units that are still available that we have a plan to acquire in the next couple of years and add on to that. So in total, we're hoping in the next 2 to 3 years we'll end up with a little over 100 and some units in this particular development. Sorry, go ahead.
No, I was gonna say, will that be the entire complex at that point?
That would be the entire complex at that point. Once we add on the other 20 some units, that would be the entire complex. Yeah.
Okay. Good. And
Yeah.
so this was marketed, through an email from a broker, a list of some sort. So you came across your desk, you looked at it, and at what point did you decide this is something that you maybe want to pursue? And then kind of at what point did you go down and tour the property?
Yeah, I mean, the process for us, it starts and end almost with a quick sort of back of the napkin math on something. When you do that, and then we actually, after the quick back of the napkin math, if that works, which it did in this case, we take it to one step further and do a quick underwriting for it, just to see where the numbers may lie. We plug in some of the numbers just from the initial OM that was given to us from the broker, some of the earlier numbers that they send us. Obviously, you always want to get T12. You always want to get rent rolls. Always want to get, that's at a minimum in order for you to really take a look at financial stability of an asset and whether it makes sense to underwrite it or not. So, that is the number one starting point. If people don't provide that for you, I would that there's no place for you to move beyond that, because a lot of times I come across assets and they're like, well, we can't, give us what your thought is and we'll provide you some financials. And that doesn't happen often, but every now and then you come across somebody who's just either playing games or something where they're not going to give you the full financials, and we walk away. We're like, yeah, that's not going to happen. I mean, we can't give you any solid feedback or numbers or underwrite something unless you give us the updated numbers, and that includes the T12 and rent rolls. So once we did that with Petersburg Place and the numbers worked for us, then the process usually for any again, not just for Petersburg Place, but for any asset we acquire, is we go down and take a look, and we walk the property and do an initial walkthrough, which we did. We liked it even further. You always on your walkthrough, you kind of take notes of what you see as opposed to what's on paper, what's in real life and what's on paper, and hopefully the disparity between the two is not that great. And hopefully, in best case scenario, it exceeds your expectation. You look at it and you're like, wow, this is even better than it was on paper. And it happens every now and then. Petersburg Place was one of those places where you took a look at it and we liked it even more in person than we liked it after looking at it on paper. Again, it's a great community. It's got a great community feel to it. The apartments themselves are big, spacious. They are a perfect place setting for a family. They are in a great area. Also, the second thing we take a look at when we do an acquire is obviously sort of pan out and look at what's around the area and what's nearby. Obviously, a lot of the factors that go into evaluations for us is sort of the economic stability of the area, the demographics, the jobs, the job centers, like who's around, who's not, where are they coming from? This particular asset happened to be in an area called Martinez, which is somewhat of a suburb, I guess, of Augusta, but it's a really nice suburb. It's an affluent suburb. There's a country club about a mile and a half, 2 miles away from it. Great job center. The average household income in that particular area is about $20,000 or $30,000 above the average Augusta area. So if you take you look at what the average incomes in Augusta, they're in the upper 40s per household, and in Martinez, in this particular area of Martinez, Georgia, the average household income is approaching close to 68,000. So it was that to us was a great indicator that it's a great area. It meets a lot of our demands, meets a lot of our checklists, and so we keep going forward in the process.
And so once you went down and you actually toured the property, how soon after that did you end up submitting your offer? Because I'm assuming since this was brokered or offered through the email list or whatever, there's probably like a call for offers day for you to be able to submit your offers. How soon after that did you submit your offer, and how many rounds of offers did you end up going through?
I think we submitted our offer about probably a couple of weeks, 2 or 3 weeks after we saw the properties. And as far and then you make it to best and final, obviously, and there was I believe there was not a whole lot of groups in best and final. Like normally there's about, in this environment in the past couple of years, our experience have been you get to the best and final and you're best and final with 10 other groups. and you have to compete with 10 other groups, and down from 40 groups or 30 groups that you started out with from the initial offers. So it's been an insane environment here, as you know. But this particular one happened to, there's only two other groups, I think, in the best and final. And mainly, I think, because of the challenges of what this property is, because this property, as good as a lot of the things were checking the boxes for us, the challenge for it was that it's a broken condo project. Was the fact that there was an HOA, there was a homeowners association that is in place, and that has that has to still be in place for the next couple of years. Now, once you take over, and once we took over this asset, obviously it's 82 units of 100 some units asset. So we are the majority owner of the complex at this point. And once you are a majority owner of the complex, you have obviously voting rights on the HOA, but you still cannot disband the HOA until a certain amount of time have lapsed in the documents themselves that were stipulated. So we still have about a 2 years time period before we're able to dismantle the HOA. So that presented challenges for any buyer. And that mainly the challenge that you have from buying a broken condo project that has an HOA component to it is the lending, especially if you're going after agency lending, which is what we generally do. We generally do Fannie Freddie type of loans. So that, I believe, kind of it truncated the amount of willing and able buyers on this property. So that's why we're only competing with 1 or 2 other groups as opposed to 10.
Yeah.
We normally do.
I was going to say, I was one of my questions for you is like, the moment we get a deal across our desk and we see broken community, fractured community, all that kind of stuff, it's usually a delete button. So what was it about this deal, or do you have experience in other assets doing the same thing? Or what was it about this deal that made you still want to go after it?
Well, I mean, look, the numbers, Dan, always make sense to us. I mean, we are very, very much numbers driven. If the numbers make sense, then we'll go forward with the deal and we'll try to make it happen as best we can. If the numbers don't make sense, numbers don't make sense. It doesn't matter how pretty the deal looks. It doesn't matter how much we desire it. It doesn't matter, what's going on in the area. If the numbers are just not going to make sense, we're not going to make money for us or our investors, and we pull out. And it's as simple as that. For this one, the numbers made sense. The numbers kept making sense. The more we looked at it, the more we underwrote it, the more we looked at the numbers and the renos and everything else that we have to do. Numbers were looking better and better. So it was worth it to us to pursue it. Plus the fact that we liked the community, plus the fact that we liked the growth in that area and the possibilities that we could do in that area.
And you already have a presence in that market too, so that's also a plus.
Exactly. And we already have a presence in the market, so we don't have to recreate something from scratch because we already have presence in the market, and we can really easily shift our people around as far as the property management is concerned. So all these things kind of came in concert together for us to continue pursuing this property.
Yeah, well, that definitely makes sense. So in your offer on this one, did you end up having to put up hard money day one?
We did have hard money, but typically our hard money is still tied to certain parameters. It wasn't hard money with no other contingencies at all. We typically have hard money, but we do have some contingencies to them, and especially contingencies that were tied to the seller. So if the seller defaults on something or pulls out or something like that, it's our hard money that does have a recourse clause to it. So. We rarely do deals that have some crazy hard money, no questions asked, no contingencies, no inspections to it. We hardly do those kind of deals. Those are not the kind of deals we typically do. We're simply not that desperate to get properties added to our portfolio. And if we have to walk away from a deal because the bidding got crazy, we walk away. I mean, it's first and foremost, we want to make sure that we are doing something fiduciary with our investors' money, and if it means walking away from something instead of plopping down $500,000 or $1 million and at risk, we just don't do that. So there was a little bit of a hard money component to it, and then obviously we still have to go through and do the inspections and walk through and all that kind of stuff.
And for those of you who are listening, when we talk about hard money, we're not talking about a hard money loan. We're talking about money that goes hard or is non-refundable at a certain point in time throughout the process. So it could be hard money that goes hard day one, which means the day you sign the contract, it becomes non-refundable. Obviously, like John's mentioning, there's usually some contingencies in there from seller representations and things like that. But then there's also that, typically you'll mostly see, earnest money that will go hard maybe after due diligence. So after that 30-day or 60-day due diligence, whatever you had negotiated with, then that money becomes non-refundable, and is what they would call hard money. So just want to make sure I clarified that, because I know some people listening might be kind of thinking about hard money loans, and that's not what we're talking about here. So we're not talking about getting a hard money loan to be able to acquire a property. So let's move on to due diligence, John, and talk a little bit about maybe some things that maybe came up during the due diligence process.
Yeah, so our due diligence typically involves some further financial spreading. At that point, once we actually once we win an asset, then we go into high gear as far as all the other steps that we need to take. The financials then get a complete revamp, and the numbers that we have stipulated in our underwriting, at that point we have to go in and verify on the ground. So the numbers that we estimated have to be hard. And anything that we think that we thought we needed to do, just from looking at it from an outside perspective, they have to be confirmed and verified and accounted for down to the penny. And also there's an actual inspection process. We do an inspection on all our acquisitions that involves a unit walkthrough for every single unit that we acquire. So if we acquire this particular one, 82 units, we walked 82 units. If an apartment complex has 250 units, then we walk 250 units. We have to see each and single one of the units that we acquire. And we do that for two reasons. We do that, to verify that you're not getting the best of the crop when people show you a sampling, that the sampling represents the entirety of the assets. So sometimes people show you 5 units or 6 units, and they cherry pick the best 5 or 6 units out of a property. If you don't do a walkthrough for the entire property, the rest of them may look like crap, and you don't know what's going to look like. So unless you do a unit by unit walkthrough on all the units that you acquire, you're taking a risk. You're taking an unnecessary risk, because it's your right to inspect every single unit. So that is one thing we do on every single one of our acquisitions. And we've pulled out of a couple of different deals because of this unit walkthrough. We had a walkthrough a few years ago where that was the case, where they gave us a sample, sort of cherry pick sample units that looked good on the outset, and then we did the unit by unit walkthrough, and we discovered so many units that had either illegal build out in them. The tenant profile was completely not what they described. There was major structural deficiencies. It was a nightmare. And we actually stopped the tour almost 60% of the way, and we said, we're not interested anymore. Unless you drop your price by $1 million, we're not interested anymore. And we pulled out. We pulled out of that deal. So it pays to do a unit by unit walkthrough. The other reason we do the unit by unit walkthrough, again, is to sort of make sure that you are estimating correctly your renovation budget and what you need to do. A lot of times people will tell you that, we've renovated 15% or 20% of the units, and we did this and this in the reno. And if you do a complete unit walkthrough, sometimes you discover that it's not really 20%; it's more like 12% or 15%. So you have a lot more renos to do than you anticipated. So I'm not saying people will trick you. I'm just saying people will always overestimate and
they might trick you. I wouldn't put it past these people.
People will trick you. I'm just saying I don't want to assume the worst. I like to always assume the best, but I want to be cautious.
Trust but verify.
Trust but verify. Exactly. You want to trust but verify always, and that is the second and most important reason that we do a unit by unit walkthrough, because you really have to know exactly what your renovation is going to look like, how many units are you going to renovate, what does the renovation that's in place look like, And if indeed the numbers are what was represented to you, which means 20% or 25% was renovated, is it indeed 20% or 25%, or is it really more like 10%? So these are the two main reasons we do the unit by unit walkthrough. And when we did that with Petersburg Place, we were pleasantly surprised in a good way, because our renos were, again, the numbers were very well favorable to us. The apartments themselves look great. We rarely had any. We didn't have any problems. Actually, we didn't have anything noticeable that when we walked through that had any red flags to us during the walkthrough. So that was a good part of the process.
What about during the inspections? Did you have any issues come up during the inspections?
No, I mean, we didn't have any. Not really. I mean, just a couple of things here and there. There's some parking lot stuff that we needed to address. A couple of roofing issues that needed to be addressed. There was a couple of buildings had some squirrel damage or something like that on part of the roof that we have to address and add it to our underwriting, but nothing really major.
Were there any issues that the lender required you to hold back additional in reserves, or they required to hold back some in reserves to help to pay for some of those items, or was it just something that you had to get done within 60 days or something like that after closing?
There was, but it was accounted for. The main problem with the lender that we were having is the fact that it was a broken condo project and there's an HOA. I mean,
I'm assuming you probably did a bridge lender.
Well, no, actually, that's what we were trying to do. And but we wanted to do an agency loan, so we wanted to do a Fannie loan, and that is really where sort of initially the lender thought, oh, may not be any problem, which we should have known that there might be some problems. Once the lender told you there's not going to be a problem, this should be a piece of cake. You should always assume that's not going to be a piece of cake, and there's going to be problems. So. Yeah, there was some initial issues with it. There wouldn't have been any issues if this was non-agency lending, but this was an agency lending. This was an agency loan, and it was a Fannie loan, and we wanted to make sure that all our numbers are right, and that the holdbacks are correct, and reserves are correct. So we were just having trouble lining those items up with our lender. Eventually it was worked out, obviously, and we closed. But it definitely took some tug and pull.
Did you end up using Fannie?
Yes.
You did. Okay. All right.
Yeah.
So you're able to get it finished with Fannie. And what was the purchase price on this one?
Ended up around $85,000 a door.
Okay. So roughly 7.1 million, somewhere around there, 7.2.
Yeah, exactly.
Okay. 7.1, 7.2. And what kind of interest rate did you get on it?
We got really good interest rate. I mean, by the time we closed on it, we had estimated, when we were going through the close, we were estimating a little over 4, but we ended up closing right at 4.
Okay. So Fannie at 4%. And what were the terms? Was it any IO, or was it?
Yeah.
I'm assuming 30-year AM with 10-year fixed with some IO.
Yeah, we had hold on a second. Actually, I just want to verify if it's a 3-year IO. I believe it was 33-year IO.
That sounds about right for that size of an asset in that market.
Yeah, it's 30-year AM, 10-year, and 3-year IO.
3-year IO. Okay.
Yeah.
It's not bad.
No, not bad in this market, especially. And again, it's always a pleasant surprise to us when we go to closing and the interest rate drops, even if it drops, 10 bips, 10 basis points or 15 basis points, that still helps a lot. It helps the investor at the end of the day, not just us.
Yeah.
So.
Well, I'm sure that, fast forward to today, now we're in the middle of the pandemic, if you will. You're very glad that you closed that thing in the middle of February instead of having to try to do it in the middle of March.
We are extremely lucky that we closed in around the beginning to the middle of February as opposed to now. It's been a doozy of an environment in the past few months for all owner operators. I mean, or all sponsors to try to get something. And main problem, Dan, as you know, I mean, you guys are also lucky enough to have closed something recently. Is really the financing on the assets, and really the numbers have been very, very challenging to nail down because of the because of the non-payments and the default. If all of a sudden you went from having something very predictable, 96, 97% occupancy, 95% occupancy with hopefully no more than the average 2.5% collection, to as high as 12% collection, 15% collection, 20% collection in some. I mean, it just it runs the gamut, and all of a sudden lenders are scrambling to figure out, well, crap, I don't know how are we going to figure that out? Are we going to hold back? Are we going to have you do double the amount of reserves so you can account for that default rate? Are you going to have you're going to have double your numbers? You're going to have to wait. I mean, it's been very, very challenging to get something nailed down.
So on this one, because it was pre-pandemic, pre-COVID, there was no interest reserves or anything like that you had to put up.
No. This was before all this craziness.
Yeah, we had to do 9 months, and the deal we closed last month. So.
Oh my goodness! Wow. Yeah.
And the stipulation on it was that once the local COVID-19 kind of state of emergency was lifted, you could apply after 90 days to get that returned.
Oh wow! Yeah. We've looked at a couple of different acquisitions recently, and yeah, that was similar stipulations with the lenders. You have to reapply 6 months later or 9 months later, whether to get some of these reserve. Really, 10 months. One of them we looked at 10 months later. Some of these reserves lifted, and at that point you have to kind of reconfigure your math altogether, specifically to investors, because you're going to have to tell investors you're going to get something one rate first year, and then the next year your rate is going to change altogether. Yeah. So it's challenging. How did you guys figure the sort of the distributions are going to be the first year then as opposed to the second year?
Well, on this particular deal, it was just under a $50 million acquisition. So we had already accounted for about $1.2 million in operating reserves. And so we already had funds there available to be able to, put up for the 9 months of interest reserves. What's interesting is that, what a lot of investors think is that it's actually just 9 months or 12 months or whatever it is of just the interest, especially if you have an interest only payment, but it's not. So they actually take into even if you get 3 years or 5 years of interest only, they require you to put up the principal and interest as if you were paying it without being interest only. You have to put that amount up for 9 months. It ends up being a pretty significant chunk when you start to include the principal payment on top of it.
Yeah. No, absolutely. Yeah, it definitely. It could make a deal non-feasible. I mean, it made a lot of deals that we looked at in the past 3 months non-feasible. That's why we haven't bought anything since February.
Yeah. No, it's very challenging, especially deals that are value add right now, because not only is the debt all over the place and hard to calculate for and hard to account for, but you also have the unknowns as it relates to, rent growth assumptions over the next 6 to 12 months. And, how long is it going to take to renovate, based on the various, closures of different cities and locales. And so there's a lot of, uncertainty as far as any type of assumptions even when you're underwriting, that if you try to be really conservative with it, the deals just don't pencil with what the buyers want, with what the sellers want to sell for right now. And I think it's going to take some time for them to be able to get to those realistic numbers, for those sellers to either come down off their numbers, or it's going to take time for us to see what is the true impact that the pandemic is going to have over the next, 3 to 6 to 9 months. So we can actually have some better underwriting and assumptions so we can actually start to win some of these projects. But right now it's just very challenging because the underwriting is all over the place, depending on what the assumptions are.
Yeah. No, absolutely. And I think that the more as we continue to sort of hopefully exit out of this environment, you'll see a little bit more stabilization of numbers and assumptions, and those will hopefully create a better environment for sellers and buyers.
Yeah. So how did you end up structuring this deal with the investors?
A lot of our deals are structured investors. The way we syndicate our deals is we typically put in anywhere between 10 to 20% of the equity stack ourselves out of our own pockets. and then the rest of it is syndicated out to investors. So this particular one was not a huge raise. It was really ended up being a less than a $2 million raise for us, which is really, really small. I mean, again, I have to preface that this deal is atypical for us from a deals perspective. We usually don't even look at deals that are this small.
Mm-hmm.
The only reason we like this deal is for all the other aforementioned reasons that I talked about in the beginning. But typically, most of our deals are 150 units and over. Our average equity stack is usually in the 3, 4 million, 5 million and over. So this one has happened to be a little under 2 million. We got oversubscribed just because, again, not a whole lot of capital to go around, equity to go around. And we had a lot of investors that were lined up that we wanted to be able to give them the opportunity to get on this deal. Unfortunately, I couldn't get everybody that wanted to get on this deal. So to answer your earlier questions, again, we usually structure it to where every one of our deals pays out a distribution, a quarterly distribution after investment. That usually kicks in 1 month to a quarter after the closing of the investment. So all our investments, you get cash on cash returns, annualized, paid out quarterly. And then obviously you participate in the upside at the time of liquidity events, which happens to be anywhere between 3 to 5 years. That's our average hold time on all our assets is 3 to 5 years. Mm-hmm. This particular asset is because of the great interest rate that we ended up with, and some of the financials that we ended up with came up even above and beyond our expectations as far as what the numbers were going to look like. It's gonna average out, not considering year one, the average hold time for this. The cash on cash is going to end up being in the 14% range, and the average IRR is going to be closer to the 17-18% range. So it's going to be close to 1.9x of your return multiples.
And that's going to be on a 5-year hold.
Yeah. 3 to 5 years is our average. So our stipulations is 3 years. The numbers that we calculated are based on 3 years.
So when you go in, I'm assuming that's for the first 82 units. When you go in to buy the next, say, 24 units that are available in that property, are you going to basically syndicate a different deal for that next 24 units? Or would the current syndication just open up again to be able to raise more funds to be able to acquire those 24 units? Or would you just refinance the current asset to be able to have extra proceeds to be able to buy the next 24 units?
We are going to open it up to current investors to reinvest back in. So they're going to get first dibs, essentially first right of refusal to invest more into those extra 20 units that we don't. If they pass, then we go to second line of investors and bring in new, fresh investors in the deal. But our current set of investors that are in this deal now are going to get first dibs, essentially, whether they want to invest more for that 20. Right. And the 20 units are going to be, minuscule in comparison. We're probably going to need a few $100,000 to close that round.
Yeah. And so do you typically do a preferred return with your investors?
Yeah. We do. Our preferred returns usually anywhere between 8 to 9%.
Okay. So doing a preferred return. And then is it usually 70-30, 80-20? What is it usually? Or do you not have usual? It just depends on the deal.
There is no usual. It is dependent on the deal, but on an average, we start out at 75-25 or 70-30, and then we have performance kickers that change that formula and hurdle rates. If we meet them, we increase our participation, but obviously they're getting more. So usually if it starts out at like 10%, if we exceed 10 to 12%, it's that 70-30. Once we get from 12 to 15%, it kicks down to 65-35. Once it goes down from 15 to 20%, it kicks down to 60-40. Some deals, if it kicks down to over 20%, we make it 50-50, where at that point we're splitting the returns with investors once we get beyond a hurdle rate of 20%.
So you have multiple hurdles in that entire waterfall structure that you would be able to, change those equity splits based on the performance. So it's almost like a performance-based hurdles.
Correct.
Yeah.
So we want to be incentivized ourselves that the more the property outperforms, the more the investors will get paid, and the more we'll get paid.
Yeah. Yeah, no, it definitely makes sense. And for those of you who are listening and you're kind of wondering, like, what are waterfalls? What are hurdles? What's a capital stack? All those kind of things. I actually address a lot of these questions on our YouTube channel. So you can go to youtube.com/C/multifamily investor nation, and you can search some of the videos and prior webinars that we've done on these various topics. That'll help you with your understanding of some of the terminology that we're referencing today. So how many investors did you end up having in this particular property?
I think we ended up with close to, I want to say 25 investors.
Yeah. Sounds about right. And so moving on a little bit, before we kind of give you my last two final questions that I have for everybody, is there anything that happened on this property, issues or problems, or maybe just interesting things that happened throughout the process that you think we haven't talked about yet, that you think might be interesting for the listener?
Well, so this asset did not have amenities. So because it was built as a condo project, it did not have a clubhouse. It did not have a swimming pool. It did have a swimming pool, did not have a clubhouse or fitness facility. So the only thing it did have was a swimming pool, but beyond that, it did not have anything else, such as, again, clubhouse. It did not even have an area for work crew to store their sort of their work gear and supplies. Because it was managed by a third party, and their office was almost off-site. It was like in a shopping center nearby. So the challenge for us was to figure out how we were going to manage this, even though we have an asset in town. But our asset in town is like 15 minutes away from this particular asset, and it's not feasible for our work crew to truck anything from there to here. So we had to figure out a way to where we can sublease the office where the current the property manager was taking care of this property, and be able to store a lot of our work crew supplies and all that kind of stuff. So. We still don't have a clubhouse, but we at least have an area where our work crew can be operating out of, and our property manager can come in and sit every now and then and either collect rent or meet with tenants or anything like that. So we needed a place like that is very much near to the property if it's not on the property. We couldn't do it on the property, but we chose to sublease a place right outside the property. So that was really the only, I would say, problematic or challenge that we had to kind of figure out how to do with this property.
Mm-hmm. And so last two questions for you here before we wrap it up. What did you find, and these are kind of contrasting questions, and you'll see that here. What did you find was easier throughout the entire process on closing this property that maybe originally you thought was going to be a little bit more challenging?
I think the ease of the walkthrough and the ease of the condition of the property came in better than we expected when we did the initial underwriting and our initial assessment. I mean, we were highly impressed with the units. We were highly impressed with the structural integrity of the buildings. And the units themselves. So that definitely came in as a pleasant surprise for us after we did the underwriting.
And the last question here is what did you find that was maybe harder than you had originally expected? And I think I know what you're going to say here, but I'll let you answer. What did you find was harder than expected that in the beginning you thought was going to be a little bit easier?
The lending. I mean,
I knew that's what you're going to say.
Yeah, the lending.
Be challenging.
Yeah, we never thought that the having a broken condo project could be with an HOA could be so challenging as it did. It's definitely challenging. I mean, we definitely now have it, kind of figured it out. But I don't know if I want to do it again and again. But at least I know what to expect now if we come across another broken condo project with an HOA. But it was definitely something we did not expect. I mean, we delayed the closing by almost a month because of it. So but it was good. It was a good learning experience.
But you're glad you didn't have to delay it by another month.
I'm glad I did not have to delay it by another month. You have
because it might not have gotten closed. But thankfully, you got it through
Yes.
the finish line. And John, I really appreciate you taking some time out of your busy schedule. I know you're a busy man, and appreciate you jumping on and sharing with our audience a little bit about this acquisition. And how can the listeners reach out to you if they want to follow with you further about this deal, or maybe even follow you on some of your future acquisitions?
Yeah, I mean, they can always reach me at my email, John, John, at maccvp.com, maccvp.com. They can find me on LinkedIn under Jalal John Azar on LinkedIn. They can go on our website, maccvp.com, maccvp.com. Any of those ways are good to reach out and touch base with me. They can even I'm not even shying away from giving away my phone number. They can even reach out to me via my phone number. It's 617-519-6211.
Awesome. Well, John, thank you so much for being here. Looking forward to continuing to follow you and your group as you continue to close more deals, and looking forward to having you on a future episode as well.
I appreciate it. Thanks for having me so much, Dan, and look forward to future talks.